Gold is at its lowest price in 6 days. Read that sentence again. 6 days, not 6 months, not 6 years. 6 days. In any other context, this sentence would be absurd. No one says a house is at its lowest price in 6 days. No one measures the value of a business by its performance over a week. But in precious metals, a 6-day decline generates headlines. It generates analysis. It generates fear. And that fear, the disproportionate emotional response to a trivial time frame, reveals something far more interesting than the price movement itself. Because while gold declined modestly over 6 days, gold mining equities declined substantially more. The miners fell further, faster, and with greater conviction than the metal they extract from the ground. This divergence is not new. It is one of the most persistent patterns in commodity markets, and understanding it provides insight not into where prices go next. That question remains unanswerable, but into how the financial system processes information about hard assets. The gap between gold and the miners is not a trading signal. It is a structural signature, a recurring feature of how paper markets interpret physical realities. And structural signatures, unlike price predictions, carry information that persists across cycles. The first observation is mathematical. Gold mining companies are leveraged instruments on the gold price. This leverage is structural, embedded in their economics, and unavoidable. Consider a simplified mining operation. The company extracts gold at an all-in sustaining cost of $1,400 per ounce. When gold is $2,000, the profit is $600 per ounce. When gold is $2,100, the profit is $700 per ounce. A 5% increase in gold price from $2,000 to $2,100 produces a 16% increase in profit per ounce from $600 to $700. The leverage works in reverse. When gold declines from $2,000 to $1,900, a 5% decrease, profit falls from $600 to $500. That is a 16% decline in profit from a 5% decline in the commodity. This is operating leverage. It is not a choice. It is arithmetic. Fixed costs create a multiplier effect on profitability when revenues change. The multiplier depends on the ratio between price and cost. The closer the price is to the cost of production, the higher the leverage. At extreme margins, when price barely exceeds cost, even small price movements create enormous percentage changes in profitability. At current gold prices, where margins are historically wide, the leverage is moderate. A 5% decline in gold might produce a 10 to 15% decline in miner profitability. But stock prices do not decline in proportion to profitability changes. Stock prices decline in proportion to changes in expected future profitability discounted by risk. And risk perception changes faster than profitability. When gold declines, even modestly, even over 6 days, the market's perception of risk to mining profitability adjusts instantly. The adjustment incorporates not just the current decline, but the possibility of further decline, the uncertainty about duration, the historical memory of previous corrections that lasted months or years. This risk adjustment amplifies the stock price movement beyond what current profitability change would justify. The result, miners fall harder than gold, consistently, predictably, structurally. The second observation is psychological. Gold mining stocks occupy an unusual position in investor psychology. They are equities, shares in companies valued by earnings, cash flow, and growth prospects. But they are equities tied to a commodity that carries emotional and ideological weight. People who buy gold mining stocks often do so because they hold views about the monetary system, views about currency debasement, about central bank policy, about the fragility of paper assets. These views are deeply held. They are part of identity, not just investment thesis. When gold declines, these views are challenged. The decline feels like refutation, even when the time frame is trivial. 6 days of lower prices can generate the same psychological response as 6 months because the emotional stakes are not proportional to the time frame. This emotional amplification drives selling in miners beyond what fundamentals would suggest. The holders who bought miners as expression of monetary conviction sell not because the business has deteriorated, but because the narrative feels threatened. The 6-day decline in gold becomes, psychologically, evidence that the thesis might be wrong. This is not rational. A 6-day price movement contains almost no information about multi-year monetary trends. But markets are not purely rational. They are populated by humans whose emotional responses are poorly calibrated to time frames. The institutional investors who also hold miners respond differently, but with similar effect. They observe the retail selling. They note the emotional character of the selling. They reduce positions, not because of fundamentals, but because of anticipated further selling by emotionally driven participants. The institutional reduction validates the retail fear. The retail fear accelerates the institutional reduction. The feedback loop produces declines in miners that exceed any rational assessment of changed fundamentals. This is not manipulation. It is crowd psychology operating through market mechanisms. The result is the same. Miners fall harder than gold, but the mechanism is emotional rather than conspiratorial. The third observation is structural. Gold mining equities exist in a peculiar structural position. They are hard asset businesses valued by a financial system that is built on paper assets. The analysts who cover miners use discounted cash flow models. They project future gold prices. They estimate future production costs. They discount the resulting cash flows at rates that reflect perceived risk. Each of these inputs contains assumptions that systematically undervalue miners during gold advances and overvalue them during gold declines. The gold price assumption is typically conservative. Analysts project gold prices that revert toward historical averages rather than continuing current trends. If gold is at $2,300, the analyst's model might use $1,800 as the long-term price. This conservatism is professionally rational. An analyst who projects gold at $3,000 and is wrong faces career risk. An analyst who projects gold at $1,800 and is wrong faces less career risk because the projection was prudent, but the conservatism produces a systematic discount. Miners are valued as though gold will decline from current levels, even when current levels reflect structural conditions that may persist or intensify. The cost assumption presents a different bias. Analysts project rising costs, inflation in labor, energy, equipment. These projections are often accurate. Costs do rise, but the projections rarely capture the reality that margins expand dramatically when gold prices rise faster than costs. The model sees rising costs and moderates profit expectations. The reality is that gold at $2,300 with costs at $1,400 produces margins that the model, using $1,800 gold, does not capture. The discount rate assumption compounds the effect. Mining is perceived as risky: geological risk, operational risk, jurisdictional risk, commodity price risk. The discount rates applied to mining cash flows are higher than those applied to technology companies, consumer staples, or financial firms. Higher discount rates reduce the present value of future cash flows. Future profits, even if large, are worth less today because the risk adjustment is severe. These three assumptions, conservative gold price, rising costs, high discount rate, combine to produce valuations that are structurally below what current conditions would support. When gold declines, the models feel validated. The conservative gold price assumption appears prescient. The high discount rate appears justified. Analysts do not need to revise their models. The stocks decline toward the values the models already predicted. When gold advances, the models lag behind. The conservative gold price assumption prevents the models from capturing the margin expansion. The high discount rate prevents the valuations from reflecting the improved outlook. Analysts revise slowly, reluctantly, always maintaining the conservatism that protects their careers. This structural undervaluation is not temporary. It is persistent. It exists across cycles, across companies, across analysts. It is a feature of how the financial system values hard asset businesses. The fourth observation is historical. The relationship between gold price and miner performance has followed recognizable patterns across multiple cycles. In the 1970s gold advance, miners initially lagged gold. As the advance continued and margins expanded, miners caught up, then overshot. By the late 1970s, some miners had risen tenfold or more, exceeding gold's own appreciation. But the catch-up was not smooth. It occurred in violent surges separated by extended periods of underperformance. The miners would lag for months, frustrating holders, then explode higher in weeks, rewarding patience. During corrections within the 1970s advance, miners fell harder than gold, every time. The leverage worked in reverse. The psychology amplified the selling, the structural undervaluation reasserted, and every time the correction ended and gold resumed its advance, the miners caught up again, often from even more deeply discounted levels. In the 2000s gold advance, from $250 to $1,900, the pattern repeated with remarkable fidelity. Miners lagged during the steady advance, miners overshot during the euphoric surges, miners crashed harder during the corrections, and the cumulative return for those who held through the volatility was extraordinary. The HUI Gold Miners Index rose from approximately 35 in 2000 to over 600 in 2011. A 17-fold increase compared to gold's 7-fold increase over the same period. But within that 17-fold increase, there were corrections of 30%, 40%, even 50% in the miners, while gold corrected 15 or 20%. The pattern is consistent. Miners amplify gold's movements in both directions. The amplification is greater to the downside during corrections and greater to the upside during advances. But the upside amplification requires patience through extended periods of underperformance. This patience is the price of participation. The volatility is the cost of the leverage. The fifth observation concerns the nature of time in market perception. 6 days is not a meaningful period for evaluating the health of a monetary trend. The conditions that drive gold, debt accumulation, currency debasement, confidence erosion, operate on timescales measured in years and decades. They do not reverse in 6 days. They do not even meaningfully change in 6 days. But market participants do not evaluate conditions on appropriate timescales. They evaluate conditions on the timescale of their emotional response. A 6-day decline feels significant in the moment. The portfolio is lower, the screen shows red, the headlines confirm that something has changed, but nothing has changed. The same debt exists, the same deficits persist, the same central bank constraints bind, the same structural conditions that drove prices higher last week continue to exist this week. The 6-day decline is noise. It is real noise. It represents real money gained or lost, but it is noise in the sense that it contains no information about the structural conditions that determine long-term direction. This distinction between noise and signal is perhaps the most difficult concept in market participation. Noise is uncomfortable. Noise triggers emotional responses. Noise demands action. Every instinct says, respond to the noise. Sell when it is red, buy when it is green. Do something. Signal is patient. Signal unfolds slowly. Signal does not trigger emotional responses because it does not move with the urgency that emotions require. The conditions driving gold higher are signals. They have been building for years. They will continue building for years. They are not affected by 6-day price movements. The mining stock's amplified decline is noise layered on noise. The operating leverage amplifies the gold movement. The psychology amplifies the leverage. The structural undervaluation amplifies the psychology. Layer upon layer of amplification, all producing a movement that contains no more information about fundamental conditions than the modest gold decline that initiated it. The sixth observation is about the function of declines. Declines perform work in markets. They are not passive events. They accomplish specific functions. Declines transfer ownership. Participants who are uncertain sell to participants who are certain. The positions move from weaker conviction to stronger conviction. This transfer has a cost. The sellers realize losses or surrender gains. The buyers deploy capital at prices that may decline further, but the transfer strengthens the market's foundation. A market held by participants with strong conviction is more stable than a market held by participants with weak conviction. Declines eliminate leverage. Participants who purchased with borrowed money face margin calls during declines. Their forced selling eliminates leverage from the market. A market with less leverage is more stable. It is less susceptible to cascading liquidation. The next advance proceeds from a cleaner base. Declines reset sentiment. When prices rise for extended periods, optimism becomes embedded. Participants begin to assume continuation. They become careless about risk. They size positions inappropriately. Declines puncture this optimism. They remind participants that prices move in both directions. They enforce humility. A market with realistic sentiment is healthier than a market with embedded optimism. Each of these functions, ownership transfer, leverage elimination, sentiment reset, strengthens the market for what follows. The decline is not evidence of failure. It is preparation for continuation. This does not mean every decline is followed by continuation. Some declines are the beginning of extended bear markets. The function of the decline does not determine what follows. It only determines the condition of the market after the decline. The seventh observation concerns what miners reveal about the broader financial system. The persistent discount at which miners trade relative to gold's price reveals something about how the financial system values hard assets generally. Hard assets, physical commodities, land, precious metals, the companies that produce them, are structurally undervalued by a financial system built on paper assets. The system's valuation tools, discounted cash flow, comparable analysis, relative value, were designed for paper assets. They work well for companies whose value derives from contracts, intellectual property, brand recognition, network effects. They work poorly for companies whose value derives from physical extraction of finite resources. The models cannot capture geological optionality, the possibility that exploration reveals resources that transform a company's value. They cannot capture commodity price optionality, the possibility that structural monetary conditions produce price movements beyond model assumptions. They cannot capture the insurance value embedded in hard asset ownership during monetary stress. These failures of valuation are not errors. They are structural features of a system that privileges paper over physical. The discount at which miners trade is therefore not just about miners. It is about how the entire financial system perceives hard assets. When the system functions normally, when paper assets perform, when currencies are stable, when confidence is high, the discount seems appropriate. Hard assets are old-fashioned, unexciting, unnecessary. When the system comes under stress, when paper assets disappoint, when currencies weaken, when confidence erodes, the discount appears irrational. Hard assets suddenly seem essential, and the companies that produce them seem absurdly cheap. The revaluation of miners during gold advances is not just a trade. It is the financial system recalibrating its valuation of hard assets. The recalibration is always late, always reluctant, always insufficient, until it overshoots in the other direction. This oscillation, from undervaluation to overvaluation and back, is a feature of how paper systems interact with physical reality. The two exist in different domains. Their interaction is always imperfect, always delayed, always characterized by gaps that persist longer than efficiency would suggest. The current gap, miners falling harder than gold during a 6-day decline, is another data point in this persistent pattern. The question posed by the title, "Have miners crashed too far?" cannot be answered with integrity. The question assumes that there is a correct level, a level from which miners have deviated and to which they should return. This assumption requires knowledge of fair value, which requires knowledge of future gold prices, future production costs, future discount rates, and future market sentiment. None of these can be known. What can be observed is the pattern. Miners fall harder than gold during corrections. This is structural, psychological, and mathematical. It has occurred in every cycle for which data exists. Miners recover harder than gold when corrections end and advances resume. This is also structural, psychological, and mathematical. The same leverage that amplifies downside amplifies upside. The pattern does not predict timing. It does not predict magnitude. It does not predict whether the current correction is days from ending or months from ending. The pattern provides context. Context for understanding why the decline in miners exceeds the decline in gold. Context for evaluating whether the decline reflects changed fundamentals or unchanged psychology. The fundamentals, for gold, have not changed in 6 days. Debt levels, monetary policy, central bank behavior, confidence indicators, all unchanged. The fundamentals, for miners, have not changed in 6 days. Ore grades, production costs, reserve estimates, operational performance, all unchanged. What changed is the number on the screen, and the emotional response to the number, and the amplification of the emotional response through leverage and structural undervaluation. These are real changes. They affect portfolios, they affect psychology, they affect the lived experience of participation. But they are not fundamental changes. They are the noise that accompanies signal, the volatility that accompanies trend, the discomfort that accompanies positioning. There is a deeper question embedded in the observation that miners fall harder than gold. The deeper question is, what does it mean that the financial system so persistently discounts the companies that extract monetary metals? Gold has been money for 5,000 years, silver for longer. The companies that extract these metals from the earth are performing a function as old as civilization, converting geological endowment into monetary metal. And yet the financial system treats these companies as though their function is marginal, risky, and unworthy of the valuations accorded to companies that create software, sell advertising, or intermediate financial transactions. A social media company with no physical product, no tangible assets, and uncertain long-term relevance trades at 50 times earnings. A gold mining company with physical reserves in the ground, tangible production, and a product that has maintained value for 5 millennia trades at 8 times earnings. The discount is not about risk adjustment alone. It reflects a deeper bias, the bias of a paper-based financial system against the physical world from which it ultimately derives. This bias is invisible during stable times. It becomes visible during stress. During stress, the social media company's valuation collapses. The gold mining company's valuation expands. The physical world reasserts its primacy over the paper world. But between episodes of stress, the bias reinstates. The paper world reclaims dominance. The miners return to their discounted valuations. The cycle continues. Understanding this cycle does not provide timing for the next reassertion. It provides only the recognition that the cycle exists, that it has persisted across all observed history, and that the current discount is a position within the cycle rather than a permanent state. Gold does not rise. Confidence falls. Miners do not crash. Perception oscillates. The gap between gold's decline and the miner's deeper decline is not a market failure. It is a market feature, a recurring expression of how a paper-based financial system processes information about physical assets. The gap widens during corrections. It narrows during advances. It never fully closes because the structural biases that produce it never fully resolve. 6 days of lower gold prices have produced a wider gap. The miners have fallen harder. The headlines have noticed. The emotional responses have been triggered. None of this contains information about the next 6 days, the next 6 months, or the next 6 years. What it contains is information about the structure of the market itself, about the leverage embedded in mining economics, about the psychology of participants who hold conviction-based positions, about the valuation frameworks that systematically discount hard assets, about the oscillation between paper world dominance and physical world reassertion. This structural information persists regardless of the direction of the next price movement. It persists because the structure persists. The financial system remains paper-based. The miners remain leveraged to gold. The psychology remains emotional. The valuation frameworks remain biased. And gold remains what it has been for 5,000 years. The 6-day price is a number. The 5,000-year function is a reality. The gap between the number and the reality is where understanding lives, for those who measure in appropriate timeframes.